Moneyweb now. On the money.
This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions. Chatting now with Sean Kelly, Parity Wealth. Sean, always appreciate the time. You sent a message through recently talking around global fragmentation happening in markets. I suppose first question, when you say global fragmentation, what does this actually mean for investors? What are you seeing out there in global markets?
Morning, Simon. Always great to be on. I think there's two things happening when I say that. I think if you look for the last 3 decades, companies have built their supply chains around one question: what is cheapest? And now I think there's this second question being asked, which is what is secure? And we've seen this now with the evidence is clear. The average US tariff, entered last year 2.4%, as we saw it reach 28% in April, and now it sits near 11%. And similarly, the UN's trade body now estimates that there have been 100 new restrictions on critical mineral exports since 2020. So for investors, the issue is now, what does this all cost? Duplicating supply chains, securing minerals, and expanding electricity grids is enormously capital intensive. But it also broadens the AI story. American tech companies remain important, but I think governments now treat chips, energy, and minerals as strategic assets. And as we know, AI needs power, it needs grids, it needs copper to run off. So the question is shifting from who owns the tech to who supplies it. And that is the second development in our view, is this market broadening. Leadership is beginning to move beyond a handful of US tech companies that dominated the last decade. And we've seen this play out in the first half of this year. We've seen the emerging markets now have returned around 24%, small caps 23%. And so in our view, we're not saying globalization is dead, but what we are saying, it has become more expensive and hired a compliance team with it. And so we know the money. Yeah.
I mean, you make the point. I mean, and Mag 7, I've chatted a bunch around Mag 7. And to your point, Mag 7's not having a brilliant 2026. They're not crashing. They're not going out of business, but they're not doing brilliant. So in this sense, where are opportunities coming from this? Because as an investor, I 100% agree with what you're talking. And this is, we can see it clearly over the last 5, 6 or so years. Where's the opportunity from this broadening that we're seeing in the market?
Yeah, and this is the question. We know the money will be spent, but I think the work for investors is deciding who gets paid. What we've seen is a couple of opportunities. I think the first that comes to mind is on the emerging markets, and it's all down to valuations. It's trading at around 11.7 times forward earnings. Compare that to 21 times of the MSCI US, but that discount is part of the case. But the opportunity beneath it, I think, is highly differentiated. We see the EM mainly as 3 separate trades. You got North Asia as a semiconductor cycle, India's domestic consumption and investment story, while Latin America is commodities, currencies, and rates. I think Europe still has some good valuations, relatively cheap. It's trading around 15 times forward earnings compared to 19.2 of the MSCI World. But I would say we don't view Europe primarily as a growth story. Rather, we see it as a policy-backed capital expenditure opportunity. You got the US readiness plan and separately NATO members committing 5% of GDP spend. US small caps, I think, also shows this broadening theme that's up around 23% for the first half of this year. And lastly, we have to mention that gold and defense is probably the most direct beneficiaries of the fragmentation. Global military expenditure has increased to around $2.9 trillion at the end of last year. So the structural shift is real. And I think these are the opportunities, albeit with volatility.
So for an investor and positioning their portfolio, is this, again, to the point, we're not abandoning big tech, we're not abandoning the US, etc., but this is sort of positioning ourselves in some of these. I mean, EMs, there's lots of opportunities. We are, of course, an EM, but perhaps not one of the exciting ones out there. You mentioned gold, you mentioned small caps, Russell 2000, sort of those sort of positions to catch the waves.
Yeah, absolutely, Simon. I think you're spot on. And I think specifically for South African investors, it's important to perhaps start with looking at what you already own. A South African investor probably has, as you say, substantial exposure to gold, platinum group metals, resources. And as we know, if you own Naspers, it almost acts as a proxy for Chinese tech. So yeah. I don't think simply adding global commodities funds or a global gold ETF will increase or decrease your concentration, or probably increase your concentration. And the same logic applies if you hold offshore funds. We know 64% of a global equity index is invested in the US, and almost a quarter of that would probably sit in just 10 companies. So I think the biggest mistake is we often replace one concentration with another, and diversification is not owning the same trade in 3 different products. For investors, we need to stay properly diversified and ensure that the portfolio is positioned to benefit as market leadership broadens.
I like that. I take that point absolutely, and it's understanding, I think, oftentimes what we actually do hold and what's in it. Not always what it says in the sticker, but we'll leave it there. That's Sean Kelly. You find him, of course, Parity Wealth. Sean, appreciate the early morning time. Our poll this morning on LinkedIn is on just this point. Are you positioning your portfolio to catch the trend? I mean, Sean makes a great point, and to be clear, I mean, we're 5 or 6 years in, but this is not going away. This is going to be, I suspect, probably for much of our investment lifetime going forward. Have your vote. Have your say. LinkedIn. This podcast is brought to you by Stanlib Asset Management. Invest in more certainty to navigate volatile market conditions.